So talking about that JSE All Share Index, you can see we've been talking that the market hasn't been making higher highs for quite some time since we last saw the high. That was around about January 2018. In that time, the market has basically just been in consolidation. There we have the high there at 61,684 points. So the market has fallen quite considerably. We have as at the 28th of February, the market closing at 51,038 points. So it is trading below that 200-day moving average, which you can see is indicated by the yellow line there. We are expecting a little bit of a knee-jerk reaction here, so JSE might find some support and we get a small little bounce up, but most certainly preparing perhaps for another leg down. So normally when we go into a bear market, you normally have three legs. So you have one leg down, a little knee jerk up, and then a third leg down again. Now if you have a look at this chart here, you'll see that from 2005, that was in the early days there, you had the market which then moved sideways in 2007, reached its peak and then did a retracement. So we had a retracement there, that was the JSE All Share Index in 2006 at a low of 19,140. Subsequently, 2009, 2008, there you had the bottom of the market with it overshooting that previous low that we saw in 2006 and ending on 18,066 points. So there we have the bottom of the market, and this was then regarded as the 2008 financial crisis. Now if you look at that retracement, that's to a previous low here, which it did overshoot. So there it was 19,140 and then back down to 18,883. So the market can overshoot lower. If we also have a retracement on this move here, since 2010 we've had quantitative easing and interest rates have been coming down, and if we're expecting a retracement here, we could at least expect it to these highs here, which is 32,722 points. So that we last saw in May 2008. Okay, so we can also expect it to overshoot, so it could go a lot lower than that as well. So here we have the All Share Index at 51, and during this bear market correction we could go down to 32,000 points on the All Share Index. That's still quite a way down. So if we are moving into this bear market, the spread of the coronavirus and fear surrounding the epidemic could also be the catalyst for this actual much bigger secular bear market, which seems to be just in its beginning stages. So yeah, we need to take extra caution in the market right now. Not time to be investing at all. You need to be able to take the opportunity to go short in the market by trading the derivatives in order to make money while this market is falling. Right, now I've pulled up Trend and Trade because I want to show you the All Share Index over a 3-month basis here. And looking right back, this is going to 2003 here, where you could see the peak of the market, and then we had that retracement. That retracement in 2008 was exactly 61.8%. So in the years that followed, quantitative easing, everything else, we had the peak of the market in 2016, even 2017, 2018, where the markets continue to move higher. So this period here is the period where Donald Trump became the US president. So obviously markets very, very satisfied, and they continued to move higher. So we measure this entire move from this significant low that we saw in 2009 right the way up to that point where the All Share Index hit its high there at 61,325 points. So since then, you can see even on a 3-month candlestick here, the All Share Index has failed to make new highs. So that's since its peak there in October 2017. So 2018, 2019 been a pretty rough year for the All Share Index as a whole, and in one single flush here we are starting to see the All Share Index now correct. So on a 3-month chart we haven't broken through the significant support levels as yet. However, on the weekly chart and the daily chart, the All Share Index has just done that. So if we take this measurement again all the way and we measure 61.8%, we are going to approximately targeting the All Share Index at 34,361 points. So we are currently trading at 51,038. The All Share Index continuing to move lower for the 3rd week now, as investors get quite frightened about how this coronavirus is affecting global markets and causing major disruptions across the globe and eventually economic slowdown. So what are we supposed to do as investors? Well, look at the chart. If you read the long-term charts, financial markets are telling us the story of the long-term trend and the natural correction and cycles that take place within the markets. So at least you know stocks are trading at 51,000 now. In the not too distant future, they should be trading at around 33,000. And this is going to be a good time to buy. However, we expect markets to always overshoot that target. So 33 could be a little lower, perhaps even 27,000. It all depends on how everything's going to play out with regard to the coronavirus. So investors who are going to be holding on to stocks during this period, you are welcome to do so over the longer term. However, it all depends how long you plan to be in the market. So that must be part of your strategy. Then you are able to weather this storm and then wait for the markets to ultimately recover. Otherwise, some of us are start to get a little bit nervous when the markets start correcting, and these are perhaps the good times to take profit now. So if you have any profit in your stocks, you might want to sell those stocks, okay, and then sit this out completely and look for the turnaround at the bottom. Alternatively, another strategy, so there's 3 ways you can look at this, is to also, if you're holding on to your stocks and you would then look at trading the market down, you might want to consider moving over to CFDs, which is contracts for difference. And here you are able to sell stock and sell stock that you don't necessarily own. So that means you won't have to close your or sell your existing shares to participate in what we call shorting the market. Because while the market falls, if we anticipate that the stock prices are going to continue to fall, then obviously we short those stock and we make money as the market goes down. So the other alternative is, now I'm coming up with a number 4 strategy here, is to put yourself in different asset classes. So looking at asset classes, still staying with equity at the moment, and I want to just show you the Aussie Top 40. So this is the Aussie Top 40, so this represents top 40 stocks here on our local JSE index. And this is the reason why you want to be able to go short, because a small little percentage of the bulls is not enough to turn this Titanic around. So we're clearly bearish. So let me show you all the stocks that are bearish there on the Aussie Top 40, so that you get a good idea of the intensity and the possibility of going short in the stocks if you are trading the CFDs. So there they are listed. I've put them in sector order. We've got our banks that are weak. We've got Sasol under chemicals, that's weak. Food and drug, just one. Food producers, forestry and paper, general finance, general industries, general mining, general retailers, healthcare, household goods, and the list goes on. So we have a huge amount of stocks. All of these are on the top 40, and all of these are giving us bearish indications right now. So you want to be looking for shorting opportunities in these stocks. Let me show you what's bullish. The only stock that is bullish is Reinet Investments SCA under general finance. So the only stock that we can find on the top 40 that has a bullish sentiment. So if we're looking at asset classes, now you're going to spread your risk here in a bear market, because you know the equity markets are going to go bearish. So you've got other opportunities and to go into commodities, into a crypto or a crypto currency, such as individually, such as Ethereum or Bitcoin or Ripple, or one of the top 5 at least. And then you can also look at the bond markets. You can look at the bond markets as well, take rates into consideration. So you're looking at cash collateral management, okay, where you can take advantage of rising interest rates, which will probably ensue. And this is how you spread your risk amongst the asset classes. In order to do this, you would have to have 2 accounts. The one would be an RSA in rand denomination, and then you would have a dollar account, which will give you exposure to the offshore. You want to also take advantage of shorting stocks offshore, taking advantage of buying the new gold debenture or gold or silver contracts, perhaps even platinum. Take advantage of all the cryptos. So this is how you'll be able to spread your risk. So you're looking at gold and silver commodities, cryptos, and also a cash component for rising interest rates. And that's how you spread your risk throughout the market. But you cannot just do it in a rand denominated account. You would have to have a dollar denominated account as well. So when we're talking about getting into cryptos, we are not looking at opening up a wallet with fancy passwords and all that. So you're not actually investing or buying Bitcoin per se or Ethereum per se, because obviously, you know, we still got a lot of question marks about the digital currency and its acceptance, and it's historically been noted as being volatile. So you can either make a lot of money or you can lose a lot of money. So I prefer not to trade or buy the actual underlying digital currency. What I do is I trade the CFD on these cryptos. So I've basically got to take bets on whether the price in dollars, US dollars, is either going to go up or down, and that is how I would trade the price, the difference in price on this commodity. So I don't physically want to own it. I don't want to have to buy them and own them. I want to just trade the difference in the price, and that's effectively what a CFD is. So what I'd also like to do is also take advantage of offshore exposure. So here I'm looking at the Dow Jones Industrial Index, of which I have 24 stocks that I am able to trade there. which gives me some nice exposure across the board in terms of their sectors, like Boeing under aerospace and defense, Tesla. You want to be trading big banks like JP Morgan and Chase, food producers like Coca-Cola, American Express, Goldman Sachs. You've heard all of these big names before, as well as some of the FANGs, okay, Amazon, Facebook, ExxonMobil, Microsoft, and even McDonald's. So, this will also give you offshore exposure. In buying the CFDs, that means you don't have to buy the underlying stock. You can either go long or short, meaning you can sell or buy these different stocks, and all from one single platform and one single dollar denominated account. So you're getting exposure all over the world and not just in South African stocks. So now the list starts to get a little bit bigger when you broaden your horizons a little bit and you start having a look across the globe for some more opportunities. And we also have CFDs that are available for us to trade on our dollar account offshore. That is also in France, Germany, Spain, and it gives you a lot of access to the gold futures here. So you've got the gold index, gold futures. So you've got oil and gas across the board there. So instead of the 28, now if you expose yourself to Europe as well as the US, you have around 57 stocks to also have a look at, which broadens your horizons a little bit more. So you don't just have South African stocks, you're also looking at offshore commodities and cryptos, and that is where you spread your risk through the different asset classes. So come and join us at Share Direct on one of our many mentorships that we have available, and discover a whole new different approach to stock market trading overall.